step back and invite our next guest who's been through many of these cycles with a calm mind. Prashant Jain, the Executive Director and CIO at HDFC Asset Management, joins us to talk about that. Prashant, good morning. You know, you've been with us through many of these patches where we've seen big swoops on the downside and equally big swoops on the upside. What is your advice to investors at a turbulent time like this?
See, I think as I have often said in the past, and this just highlights once again that equities are a volatile and a hard to predict asset class over short periods of time. What we have also seen is that one should focus on the local fundamentals, because that is what is a driver of markets medium to long term. And one has observed that whenever markets have fallen despite good fundamentals locally due to global factors, these have proven to be very good times to invest in the medium to long term view. So I feel the same, that the Indian economy is on the path to recovery. Our current account is in very good shape. India has great growth prospects. Our interest rate should come off as inflation has fallen much more than what was expected. So I think all indicators are, macroeconomic indicators are green, and I think we should do quite well over time. Yes.
Okay. Well, actually, Prashant, you were with us, if I remember right, almost exactly 2 years ago when the markets were falling like 9 pins and the Nifty had touched 5,100 intraday. You were in our studio at that time, and you were telling us, will you ever get SBI at these levels? Will you ever get any of these stocks? I mean, you specifically picked up certain stocks and said, will you ever get these at these levels? Can you say that with the same conviction of many of the Nifty stocks even now?
See, I don't recall. I mean, your memory is probably better than mine, but I think there is value in this market. So I mean, you look at the aggregate P multiples, which are reasonable. Corporate profitability is at a 17-18-year low. So there are challenges in the commodity space, but I think for many other companies, margin should improve. And as we go along, I see no reason why growth rate should not pick up and interest rate should not come down. So I think I am optimistic about the markets. I just feel that the consumer companies might disappoint, because the multiples are probably not pricing in the impact of a much lower inflation, which will lower the growth rates of these companies quite significantly.
That point is well taken, Prashant, about the local impending growth story. But there is growth despair amongst global markets, and that's what's causing, widespread pessimism. Do you think the impact of the contracting demand in, say, a market like China has already been priced into global markets, or could there be some more to go?
See, one is India's share of global exports is extremely low, and I don't think our growth is more correlated to how we can grow that share and less to global economy per se. And I think on the flip side, we benefit a lot more from lower crude prices. India is one of the very few emerging markets which benefits from lower commodity prices. Most emerging markets, I think, will come under a lot of pain. So India clearly stands out as being a big beneficiary of lower commodity prices, which I think more than offsets several times any negative impact on the exports that we might see.
No, your point is entirely taken about India's strong points in this situation, a domestically consuming economy and a consumer of commodities rather than exporter. But I think both Sonia's and my question is more with respect to markets. Markets don't always reflect these fundamentals. At this point in time, since we tend to get swept away by the way global markets move, what is the sense you have made of global markets? Are they likely to price in more panic over China? Are we likely to see other such mad days and fairly lower levels in the major global indices?
See, I don't think I would like to comment on markets outside India, and there are many people who are more qualified to do that than I am. But what I can share with you is that I have seen, whether it was 2001, whether it was 2008, whether it was 2013, whenever Indian markets have been trading at reasonable valuations and they have come off sharply because of global factors. So stock markets are indeed driven by sentiment over short periods of time. And that is what we have seen on each of these occasions. But if the local fundamentals are good, after 3 months, after 1 year, these things pass, and markets, with the benefit of hindsight, you realize that it was actually a good opportunity. Nothing was wrong with the country. It's just that stock markets moved down because of weak sentiment towards equities globally. Yes.
Okay, fair enough. There has been a relentless flow of money into mutual funds, especially in the last, say, 3 to 4 months. The sentiment has picked up significantly. What would your own estimate be of how the flows will continue? Do you see the same enthusiasm continues for the rest of the year? And in terms of individual pockets, so sectoral moves, what do you see as the trend here on?
See, sectors, I think, I have been saying for some time, and I think the markets are in transition, and I think we will move probably away from a consumption-led markets to more towards investment-led markets. Investment cycles take time to revive, and I think we are in the early stages of that revival. As far as local flows are concerned, I think they should continue, because equities represent the best performing asset class. And I think the prospects going forward are quite good. And the physical assets are not doing well, real estate and gold. And in India, we have seen a massive increase in allocation towards physical assets over the last few years. And I think that process is being reversed. So I think I'm quite optimistic about local flows going forward for next few years.
Okay. Well, quietly, some good work also is continuing as mutual funds are flowing into your kitty. Prashant, here's L&T announcing that it has got a fairly massive construction order, some 1,500 crores if I'm not mistaken. So, business is as usual going on in several pockets, thank God for that. The Sensex and the Nifty is still unable to make up its mind whether to be in the red or the green itself. At this point, almost in flat terrain, and the mid-caps a little bit in the red. Prashant, what do you do with financials at this point in time? Public sector banks, private sector banks, NBFCs, since the view is that global commodities are almost in deflationary situation and may continue that way.
So I think, yes, that is a challenge, and as you rightly said, it's cyclical. So, but the loans to these companies are backed by very good assets, and there could be some stress. But we have seen in the past that whenever the local investment cycle revives, the NPAs tend to go down, and these companies do well. So I would simply suggest that outlook for financials is quite good, because India represents a growing economy, and these companies should grow faster than the economy itself. And I think there is value in companies or in financial institutions which have more loans to corporates, because there is some stress, and that is where the valuations are attractive, both in the private and in the public sector.
This injury of 1,000-point or a 1,500-point fall that we saw in the Sensex, coupled with the fact that gold has crawled back, you don't think is going to impact the flow into mutual funds? Will it? It's too short a period, you think?
I don't think so, see, because, which is more important, a 4-day move or a 4-year return? So I think clearly, I would simply say that even our gilts, government securities or GSEC funds are probably a meaningfully superior option to gold, because today the GSECs themselves are offering 4% real yield.
Okay.
I would say, I don't think that such a short move or such a short period of time will lure people back into gold.
Okay, so for investors who have a horizon of about 3 to 4 years, Prashant, what kind of annual rate of return would you expect to see from the equities here on?
See, I think, 15% is the long-term return that Sensex has delivered, and that's in line with the nominal GDP growth rates of the country. And I think that is what should happen. It could be slightly above or slightly below, but I think there is no meaningful excess in this market. If at all there is excess, it's in the very high quality stocks, which means the risk is probably a bit lower there. So I would maintain the same view, that around nominal GDP growth rates is what we can expect going forward.
Okay. I just want to come back to that one point you were making about we being in an early stage in terms of the revival of the investment cycle. You know, the government has in some form managed to push the investment cycle through higher infrastructure spending in some sectors. But the feedback that we get from companies is that they are still holding on to their purse strings, you know, waiting for some reforms in terms of GST, labor reforms, etc. How long do you think it would take for the earnings cycle to pick up and for this, you know, revival in investment cycle to flow through into the company's books?
So you are right, I agree with you that it's the infrastructure capex which has revived, which is or in the process of reviving. I think it will still take some time for the manufacturing capex to revive. And I think the reasons are twofold. One, the capacity utilization in manufacturing is still quite low. And second is the metal sector, which is a very large driver of industrial capex, is experiencing weak cycle. And I think the sentiment is also weak out there. And I hope and expect that the government considers this, because reviving metal capex is very important. So if government handholds the sector in these weak times, it will, I think, increase the confidence of this sector to invest in projects which are very long gestation. If you don't invest in the steel sector today, in 3 to 5 years time, demand in India may outstrip the local supply. So I think we need to think slightly longer term there, yes.
Okay. Prashant, please stay on. We have to take a mandatory break before 10 o'clock, but we are back with a few more questions. Director. Prashant, you know, what is the hierarchy of sectors for you at this point in time? For instance, if you were to split ₹100 incremental investment.
See, I don't think I would like to answer that in specific terms, but as I have mentioned to you, I think we are more positive on the investment-led cycle. And I think consumer discretionary is also looking quite good. But the consumer staples, to my mind, are something to be careful about. And I think we should also be watching going forward how the currency behaves. Though sentiment right now is quite weak, but I think if as the year progresses, if current account is in surplus or in balance, which I think it will be, we think it will be, then the currency might actually start doing well, which will not be very good for the export-led sectors as well.
Okay, so IT is not one of your favorites?
No, IT is good. I did not say IT is not one of the favorites. It's a good sector. We have a balanced view towards IT.
Okay.
So it's a sector which is, yes. No, please.
No, sorry. Just one final question from my end, Prashant. Between the mid-caps and the large caps, where do you see higher risk-reward, say, for the next 1 to 2 years?
I think mid-caps have done quite well over the last few years, and mid-caps are a very large basket. So a skilled person can always pick up a few winners. But that apart, at a very broad-based basis, and in general terms, I would say the large caps look better compared to mid-caps.
All right. Prashant Jain, it's always a pleasure speaking with you. And thank you for speaking to the markets at a time when people are deeply confused as to the direction of the markets and perhaps embroiled also in a whole host of trading losses. The reassurance of the longer term and the fundamental soundness of the Indian economy is very reassuring to hear from you. Thank you very much for joining us. Okay, that's one of the biggest investors in the Indian markets, incidentally, and over the last 2 years, these are the people who have also got a lot of funds from retail investors. Let's now shift to our focus on Indian economy vis-a-vis other economies and the turmoil in the global economy.